Most people, when they think about income, the first thing they think about is, well, it's how much money I made. When you go talk to a CPA, they think about income in three distinct buckets. The first is active income. Active income is where you're going to be producing any income that you're generating from a business that you might own. This could be W-2 income, any ordinary income. The second is going to be portfolio income. These are things that are going to be generated through investing in stocks, as an easy example. This is dividend income. This is capital gains from buying and selling stock. That all is going to fall into portfolio level income. And the third bucket is what's called passive income. And this is what gets talked about probably the most when you hear about people talking about passive income. What they're generally talking about is income that's funneling through a real estate investment property. Now that we know about the three main income sources and how to classify them, one of the most powerful tax discussions is how you can have them all bundled underneath the same umbrella and use depreciation or use losses from your passive income bucket to then shelter income from your portfolio and active income bucket. So the easiest way for you to be able to use depreciation or paper losses from the passive income bucket against the other two buckets, whether it's portfolio income or active income, is through becoming what's called a real estate professional. Now, I've covered this at length, and so you can click this link below to find the video towards what it takes to be a real estate professional. But for the purpose of this conversation, I'm going to go through the power of a real example of what a real estate professional allows you to do. So then now that we've set up the three main buckets of income, let's talk through a hypothetical example. Let's say that on your active income, you pull in $1 million per year, okay? In your portfolio income, you're pulling $250,000 per year. And then on your passive income, you're pulling $100,000 per year. Now, let's just say for this example that you invested $1 million that you had sitting in a brokerage account or sitting in a checking account, and you invested it into the passive income bucket through a mobile home park investment. Now, this investment generated a year one tax deduction through paper losses, through depreciation of $1 million. You invested $1 million, but you didn't actually lose $1 million. What it did is you got a non-cash loss, meaning you didn't have to effectively lose $1 million, but it's the wear and tear of that building that the government then partners with you on. Uncle Sam essentially gives you a tax deduction for investing in the US economy, for investing in affordable housing of $1 million. Now, if we've already established that you're a real estate professional, you could use that $1 million loss directly against that $1 million worth of active income. Now, depending on how your CPA sets it up, he's probably going to use it against the active income because it's taxed at a higher tax rate. Ordinary income on the high side for a high net worth earner is going to be at 37%. Versus when you look at income that flows through on the portfolio level, it's generally going to be capital gains, which is taxed more favorably at a 20 to maybe a 25% range. And so by making that $1 million investment into the passive income bucket, you're going to generate $1 million loss that's going to save you $370,000 in taxes. Now that's great, but what happened to the $1 million investment that you made? Because you don't want to lose that money. Since you invested in a mobile home park, and let's assume that you picked a great operator, and you could always check out comfortcapital.com if you want to find one of those, that investment you did not lose. That investment is going to cash flow on your behalf and make money while you sleep. On the low end, generating a 5% cash on cash, which means that $1 million now is going to make you $50,000 per year. And the way that that investment is taxed from a taxation standpoint is a return of equity. What does that mean? That means that the IRS and any state tax authority effectively says that you invested $1 million, you haven't recouped your $1 million back yet. And so the cash flow that real estate generates, you are not going to be responsible for paying taxes on that income, meaning you collect the full $50,000 per year. Now, this is a great way to defer taxation. And then the next question I would probably get is like, well, Ben, I'm going to have to pay the taxes eventually. That is true. However, you could use other strategies such as 1031 exchanges, which I talk about, and or the defer die method, which we're all going to die, and you can then get a step up in basis and then hand off wealth generationally to your heirs or your kin, to your kids, without them having to pay taxes. But what it does, it effectively reduces today's taxes, keeps more money in your pocket, compounding and earning interest pre-tax. And that money hits your bank account today in a very tax efficient way. You reduce the amount of taxes that you pay. And it's effectively a way that Uncle Sam is partnering with you and allowing you to invest in real estate deals at a discount. Now, the caveat here is that in this example, you have to be a real estate professional. So once you get over that hurdle, hopefully this opens up your mind to the amount of possibilities that are out there. Now, I didn't get a chance to talk about portfolio income, but it is very important. Portfolio income is very unique, and it really takes kind of an advanced tax strategy on how to effectively reduce your taxes. So there's something called the 461 limitation. And what the 461 limitation is that it's a way to limit the amount of depreciation or losses you could utilize against portfolio income. For a married couple, I believe the number is somewhere around $500,000 per year that you could use against portfolio income. Put differently, let's just say on that example that I said, instead of you making $1 million of active income, let's just say it's $100,000 in active income and you made $1 million on the portfolio side. This could be anything that has to do with you selling a large stock portfolio that's highly appreciated and has generated $1 million of capital gains. So in this example, we had $100,000 of active income, $1 million of portfolio income, and we generated $1 million of losses, paper losses on the passive side. Now, if we were trying to mitigate the taxes on the portfolio income side, we would run up against a limitation called the 461 limitation, allowing us only to deduct roughly about $500,000. So we would have effectively another $500,000 that would flow through and get taxed at the capital gains level. Now, if you wanted to effectively find a way to offset that entire $1 million, what you would need to do is create what's called NOLs, which are net operating losses. And what an NOL is when you generate excess depreciation in the current year, it rolls forward to the following year as what's called an NOL, which there is no $500,000 limit. The limitation is only on 80% of gross income. So put differently, in this example, let's just say that we had $500,000 of excess loss of additional depreciation that we could not utilize. It would roll forward into 2026 and allow us to then offset up to $1 million on the portfolio side, assuming that we made $1.2 million of portfolio level income, because remember, it's at 80%. So it's a great way to do multi-planning, especially if you know you're sitting on a lot of highly appreciated stock. Maybe you were someone who got into SpaceX early and you know you're sitting on a lot of capital gains, but you made a lot of money. You can utilize depreciation and multi-year planning to generate NOLs in the following year, and then timing the sell of said stock in that same calendar year when you have rollover NOLs to then utilize and offset as much of that taxation as possible. And the reason why this limitation came into play is that when they passed the 2017 and then it became the 2015 One Big Beautiful Bill, what they wanted to do is they wanted prevent people from offsetting too much capital gains by just investing in highly depreciable assets such as mobile home parks. And so that's why they put this limitation in. However, it is important to know that you should speak to your CPA or a tax attorney to then find ways to do multi-year creative planning and generate excess depreciation that can get carried forward into the following year. That way, when you do sell that stock, you can offset as much of that capital gain as possible while keeping those investments in great cash flowing, resilient mobile home parks or any other asset class that produces large upfront depreciation with a very skilled operator that's not going to lose your money and is going to drive cash flow and long-term appreciation. So if this is helpful, or if you're completely confused and you want to learn more, hit the like, subscribe button. I'm happy to go into more depth, provide more videos. Maybe I'll bring my CPA on, Andy Farkas, to talk through all this in greater detail. I'm not a CPA, but I've had the pleasure to be able to sit in these conversations with high net worth and ultra high net worth individuals with their CPAs and tax attorneys. And so that's the way that I've learned about these strategies. And it's more important to know that these things exist. And then it's about how can you implement them for your own life and your own tax situation. So thank you for joining, and I will see you on the next video.